Welcome to the AIER's Authors Corners podcast. I'm your host, Ethan Yang, and today's guest is AIER Senior Research Fellow Robert Wright. Before joining AIER, Robert taught at schools like NYU, University of Virginia, and Temple. Today, we'll be talking about one of his later books, published in 2019, Financial Exclusion: How Competition Can Fix a Broken System. Robert, it's great to have you.
It's great to be here, Ethan.
So let's just get right into it. To start off, your book's fundamentally about economic history, specifically financial history, how certain groups have been excluded from the financial system and why that's been detrimental. But to start off, Wall Street has this terrible reputation. The world of finance has this terrible reputation. Can you explain first and foremost, why is finance so important?
Ethan, I certainly don't want to defend everything that goes on Wall Street, but overall, the financial system does two very important things. One is called intermediation, and the other is called risk management. So on the intermediation side, basically you have economic entities, individuals, companies, governments that over a given period, say, a quarter or a year, have greater revenues than expenditures. So they are looking to save. We call them savers. On the other side, we have economic entities, again, individuals, businesses, governments, that have less in revenue over a given time period than what they're expending or they would like to expend. Those we call spenders, or in the case of the businesses, entrepreneurs. So what the financial system does is to link those two groups together. They're essentially trading, just like any other sort of trade. The savers would like to earn some return on their savings, and the spenders or the entrepreneurs would like that cash now so that they can go and consume or invest in infrastructure or plant, computer systems, whatever, in the hopes that that's going to turn into a remunerative activity in the future.
Mm-hmm.
So this is pretty crucial function for the economy, because otherwise you would have people who wouldn't be able to save, and so they would be spending more than what they want, and you wouldn't have anyone able to borrow, so they wouldn't be able to fund the projects that they want to fund. The other major function of the financial system is risk management. So maybe I have some aversion to risk. I want to minimize the chances that I'm going to lose. But maybe you want to take on more risk because you're looking for higher return. So there are various aspects of the financial system that, again, allow us to trade until we both have the amount of risk and return that we want. And the most quotidian or everyday type of arrangement is just straight up insurance. Or maybe I'm a homeowner. I'm very afraid that my house is going to burn down, so I will sell that risk to you. You'll take on that risk in exchange for a premium that I pay today. But if my house burns down tomorrow, you might have to pay many, many times that back to me. So those are the two major functions, and that second one's very important to economic growth, because if you think, in terms of if there were no insurance, if there were no way to share this risk, I might not want to own a house because the risk would be too great for me. And of course that would be bad. Or worse, I might not want to send a ship out to trade because I'm afraid the ship's going to sink and I'm going to lose everything. So if I can't slough off or sell some of that risk to somebody else, then maybe the voyages never take place and those gains from trade are never consummated or made.
Mm-hmm. So to summarize all that, basically the financial system allows us to take greater risks, be more ambitious, to build on what we have, and to maybe expand out. And basically, allow society to progress past, the hunter-gathering stage and, into something more ambitious like we have today.
Absolutely correct. But I'm a college professor, so I have to spin things out.
So let's move into your book, which talks a lot about how a lot of minority groups, I talk about Black people, women, Asian Americans, Indian Americans, what have you, poor white people, have all been excluded in some way historically from the financial system. And that explains a lot of the disparities that we have when it comes to income in terms of opportunities. So can you explain why being discriminated either publicly or privately can lead to these disparities, and what kind of you also explain how there's a lot of really bad opportunities like loan sharks and debt traps that are available to people who aren't included in the greater financial system.
That's correct. Yes, you put it very well. And this obviously hurts the individuals who are being excluded, but it also hurts the overall economy, because essentially there could have been trades made to the extent that there is discrimination, but those trades aren't being made due to racism or bigotry or what have you. So that's a deadweight loss for the economy, right? We want to minimize that. Policymakers should try to minimize that and to maximize the amount of trading that's going on via intermediation again, or risk management.
And in your book has a lot of very horrific and disturbing examples. So can you explain, maybe give us some examples of how the various challenges that various minority groups have faced when it comes to accessing capital and inclusion in the financial system?
Yeah, I mean, one group is American Indians, which, by the way, is what they prefer to be called. Native American is a term that college professors made up, and it's very ambiguous because I'm a Native American, meaning I was born in America, right? But I'm not an American Indian. American Indians can choose to live in the greater society, or they can choose to live on reservations with other members of their tribe or closely related tribe. The reservations are highly regulated by the Bureau for Indian Affairs, which is part of the Department of the Interior. And it's essentially a socialist system. So no outside financial groups really want to do business on reservations, because like if you're an entrepreneur, and many Indians are very entrepreneurial because they're excluded from the wider job market, right? So when that happens, you tend to look to start up your own business, but they can't find financing most of the time because they have a different land tenure system in many instances. And the BIA even restricts things like their signage. So many Indian businesses, you might drive through like Mission, South Dakota, or Pine Ridge and whatnot, and you're like, oh, there's no businesses here. Well, there actually are businesses there, but they're not allowed to advertise. So if you can't advertise, and you are doing everything under the table, you can't take like your financials to a lender and say, these are the characteristics of my business, right? Because everything's under the table. There's no way to verify it. So they find it very difficult to get loans. And then that squelches entrepreneurship and saving on Indian reservations. And it's little wonder that most of them, except for the casino related ones in urban centers, most of the reservations are very, very poor. And it's really, it's nice to look at what goes on there or what doesn't go on the reservations, because that could be all of America if we had a system like the BIA that was squelching the financial system, for everyone.
And in your book, you talk about how there's a lot of harmful stereotypes that aren't true. You talk about how a lot of excuses are Native Americans are not like are inherently anti-capitalist. They don't understand finance. Black people are bad with money. Women are not ambitious enough to take these loans and start, like all these harmful stereotypes. And you prove in your book just how wrong these are, and you give examples of why Native Americans do have a great tradition of finance, or Black people are great with money, and so on. So, can you give some examples of those stereotypes and how that's really not true?
Yeah, I'm much bolder in the book than than on camera, but I will talk about my own group, which are poor whites, um, especially of Irish origin, and we are depicted as lazy, shiftless, drunk. We like to have relations with our close relations, if you know what I mean. Um, can't hold a job, and so on and so forth. So when anyone who's in a stereotype group goes into a financial institution, at the margin, at the competitive margin, meaning if there's a member of another group who isn't subjected to that sort of stereotyping, shows up with someone who is, um, the one who's the member of the group that's not stereotyped is much more likely to get that loan or get that insurance policy, um, than the one from the stereotype group. Because if you just put yourself in the shoes of the financial institution, the loan officer or the agent or whatnot, the insurance agent, why give any preference to the one that might come in and you think might come and nip you, right? So you play it safe and you go with the one who you believe for whatever reason is going to be less likely to default on the loan or to engage in insurance fraud, uh, and so on and so forth.
And you've also mentioned that we've explained, how minorities are exploited or are excluded from the financial system. There's all these systematic issues. But you also talk about how the government tries to step in and rectify this situation either through public lending programs or publicly subsidized lending, like Fannie and Freddie Mac, or just having these odd regulations and interventions. So can you explain how damaging that has been and why that's really not the solution we should be going for?
Well, it was one of the major causes of the global financial crisis in 2008. Basically, what happened was people were looking at the, the percentage of African American mortgage applicants who were turned down versus the percentage of white or Asian applicants who were turned down. And the turn down rate for African Americans was palpably higher than for the whites and the Asian group. So people looked at that and said, oh, prima facie evidence. There's what we would today call, this is going on in the early 90s, so they didn't quite use the term, but systemic racism built into the system. The problem with that is that the applicants are not necessarily the same in terms of the credit risk involved. That for whatever reasons, African Americans were higher credit risks than members of these other groups on average. So they should have had a lower acceptance rate on their mortgage applications. Just objectively, right, from the standpoint of the lending institutions. Well, there was a study out of the Boston Fed that said, oh no, we've used these statistical techniques and we can tell that there is discrimination. But then what's the old saying? There's three types of lies: white lies, damn lies, and statistics.
Mm-hmm.
Well, some other people came along and said, well, we can't really So they started to collect data, but the data was incomplete. It didn't necessarily capture all of the objective qualities of applicants that loan officers look at. So while this sort of scholarly debate is going on, um, the federal regulators decide that they have to do something. And so they started to pressure banks through something called the Community Reinvestment Act to lower their lending standards. And they pretty much lowered their lending standards for everyone. Yeah, we both break out laughing because we know the end story of this. When you lower your lending standards for everyone, you're going to have higher default rates. Now, there were claims that they could get around this by packaging these into securities and then sell, asset-backed mortgages and collateralized securities and so on and so forth. And selling them to investors. But it turns out their models were all wrong, and that it was quite possible for there to be a shock big enough that would cause the very illiquid markets, the very thin markets for these things to dry up, and for their prices to essentially plummet or be unknowable, which is what happened at the very pit of the problems in 2008. So since then, the feds have tightened up more on mortgages, the crazy types of mortgages where you didn't have to have any money down, you didn't have to supply any documentation about your income, and so on and so forth, are pretty much a thing of the past. Knock wood, right? At least for now. I just went through a mortgage process that was so stringent that I ended up just buying the place with cash.
Wow.
Which tells you something. When somebody who has the cash resources can't get a loan. Again, there were circumstances in there, but in 2006, I would have been able to have borrowed 125% of the purchase price for the property, right? Which is insane when you think about it. But so that was the response. So since then, there's been this sort of back and forth, and I wrote the book to kind of point out, hey, we have a long history of this, of mitigating, because there have been examples of exclusion and discrimination, as we just talked about, but of mitigating it, right? Because in reality, you don't solve problems generally, you mitigate. So what's the best way of mitigating financial exclusion and discrimination? And I looked at our long history, and it turns out that that financial history can be read essentially or interpreted as people who felt discriminated against entering into the financial system and providing those two key services of intermediation and risk management for themselves. And so maybe what we should do is loosen up the barriers to entry that have cropped up over the years, especially after the S&L crisis, and allow small financial institutions to form to service particular groups. And that ultimately is a real world test of whether they're being discriminated against or not. Right? So maybe you have the Amish being discriminated against. Right? Let the Amish form their own banks and lend to other Amish. And if that bank thrives, well, then maybe they were being discriminated against. But if they form their own bank and it fails, well, then maybe they shouldn't have been getting the loans in the first place, right? So test it. And this is what's happened throughout American history. The Irish couldn't get loans when they first came here. So they set up their own banks, their own savings banks, their own commercial banks, their own insurers. Many of them thrived. And great. So now they're being served. Right? Now those key economic functions of intermediation and risk management are being met for this large segment of the population. Women at various times have formed their own stock exchanges, have formed their own banks. What oftentimes happens is that they form and they don't go under right away. They might not be wildly successful, but then they get integrated into larger existing institutions that have economies of scale. but they sort of proven the concept in the real world in the marketplace. But the only way that can happen is if the regulators allow entry at relatively low cost. They are so afraid that, oh no, 100 banks are going to go under. Well, if all the banks are tiny, or if all the insurers are tiny and they're just sort of like proof of concept, what's the big deal? It's not. The FDIC can handle it. The insurance guarantee funds can handle it. Now, I'm not saying that we should have zero barriers. You don't want,
Well, don't tempt me with a fun time.
we don't want just but they could be loosened much more than they currently are. I know a fellow who was making a very good living simply being a consultant to people who wanted to form de novo banks because the process was so complicated and convoluted, and he developed a reputation with the regulators that, hey, if a group's going through this particular consultant, that's a signal that this is a quality group and they'd be more likely to go. But he's earning these rents off from that, and essentially raising the cost just as much as regulators were. So those could all be lowered without endangering the financial system. Much safer to do it that way than to say, oh, anybody can get insurance for $2 whenever they want. That's a recipe for disaster. Everyone gets, bank loan for you, bank loan for you, bank loan. That's disastrous. But allowing a group that feels as though they're being discriminated against to give it a try. I was involved before the financial crisis hit in the Handy Bank, which was going to be a bank for people with sundry, we used to call them handicapped. I'm not sure what the disabilities, physical impairments, the blind, the deaf, because they felt discriminated against in banking. And it's a big enough population in places like Chicago that you could have a bank that just catered to them, that would be way beyond ADA compliant and would have websites that would be both, you could both listen to, and it would have large print and so on and so forth, have, people in wheelchairs working as tellers and whatnot to create an inclusive, inviting atmosphere. The financial crisis killed that, but that's how niche they could be if necessary.
So you actually ended up answering my last question with that response, but I guess we can reiterate and maybe dive into something a little bit deeper. But we just talked about how the financial system obviously has its problems, but unilaterally and arbitrarily introducing loose credit and arbitrary restrictions is probably not the best way. Change needs to come from the bottom up, not the top down. We've established that. So how, I guess to end, and how do we really realize that promise of allowing change to come from the ground up in the financial system? And how can we leverage competition, or how can competition be leveraged to ensure that the financial system going forward is increasingly more inclusive? I guess what I'm talking about, like what can the policymakers and the government do? What can people on the ground do? So let's end on that note.
Better education. Too many people grow up in this country learning that they're consumers and only consumers and maybe workers. Only in a few places, like in South Dakota, is there an active curricula in entrepreneurship where kids are told, you could have your own business. This is how you go about doing it. And then have projects, related to them creating little nano businesses. And of course, not all of them go on to be entrepreneurs, but at least it's in their head that they're not just workers and, taxpayers and consumers and whatnot, that they can actually be innovators. And that requires them to have access to the financial system or to innovate in finance, right? To form their own business in finance. Because too many people, when they think of finance, they think, oh, some big Wall Street firm, and I'd never have the kind of money to start that. It shouldn't cost that much to start most of these things. Uh, Credit unions are a huge component of the book and a huge way of increasing inclusion because they don't need a lot to start up. They run all of their back office stuff, all the high tech stuff, through these corporate credit unions that specialize in that. So it's mostly about uh, you know um, customer service of depositors, borrowers. And many of them sell insurance or act as insurance agents, if only to help their members, as they technically are, to obtain that side of the financial systems benefits as well.
And I guess we'll end on that note. Robert, thank you so much for hopping on the show today. Robert's book, Financial Exclusion, is available on AIER's website as well as Amazon. To keep up with more of our content, please follow AIER on Facebook, Twitter, YouTube, as well as check out our website at AIER.org. If you liked what you heard and you want to support more programming like this, more rigorous economic analysis and research, please consider donating to AIER at AIER.org. Thank you.